The market is currently closed. ServiceNow Inc., new exchange trading symbol NOW, finished its last trading session on Friday, January 9, 2026 at 4 p.m. EST at a price of $141.80 USD, marking a sharp decline of $4.39 or 3.00% for the day. While most investors are looking at that 3.00% drop and feeling the sting of a broader software sector pullback, the real story isn't just the price action on the screen. It is the massive divergence between what the institutional desks are doing and what the retail crowd is whispering about. Most people see a tech giant struggling to maintain its high valuation in a tightening economy. But if you look at the volume spikes we saw late in the session, there is a quiet accumulation happening that suggests the smart money is betting on a very specific outcome for the upcoming January 28th earnings call. The general belief right now is that ServiceNow has hit a ceiling. People think the high growth of the previous decade is finally tapering off and that the company is becoming a victim of its own success. You hear it everywhere. Critics argue that enterprise budgets are tapped out and that the transition to more advanced intelligent agents is going to take years to show up on the bottom line. But here's the reality that contradicts that safe, middle-of-the-road take. ServiceNow isn't just selling software anymore. They're selling the actual plumbing for the next generation of business operations. While the stock has pulled back nearly 30% over the last year, trailing the performance of a tech powerhouse like Nvidia stock or even the steady climb of Apple stock, the underlying fundamentals are showing a company that is leaner and more essential to the Fortune 500 than it has ever been. Looking at the daily swings, we saw the stock open at 147.35 USD on Friday before falling steadily throughout the day to a low of 141.43 USD. This wasn't just a random dip, it was part of a larger 16.98% slide over the last month. When you see a high-quality name like this get hammered while the S&P 500 stays relatively flat, it creates a massive tension. Investors using platforms like Interactive Brokers or checking their balances on the Robinhood app are seeing red, but institutional activity tells a different story. We have seen a significant increase in block trades over the last few days, particularly at the 142 USD support level. This suggests that large hedge funds and wealth managers, perhaps those managing a Fidelity Brokerage or Schwab Intelligent Portfolios account, are seeing this as a generational entry point rather than a reason to flee. The momentum in the sector has been tough lately. We're seeing macroeconomic pressures from high interest rates that make the high price-to-earnings ratios of companies like ServiceNow look risky. Right now, ServiceNow is trading at a trailing PE of about 88, which sounds expensive until you compare it to its historical average of well over 100. The market is pricing in a slowdown that hasn't fully materialized in the actual contract wins. Comment below how many shares of ServiceNow you currently hold, or if you are waiting for it to drop below the 135 USD level before you pull the trigger. The tension here is palpable because the expectation is that the fourth quarter results will be soft due to government budget tightening. However, the reality is that ServiceNow recently signed several major deals in the defense and critical infrastructure sectors, specifically through their acquisition of Armis. They are moving into cyber exposure and security, which are non-discretionary spends. When a company can move from being a nice-to-have IT desk tool to a must-have security and operational backbone, the valuation logic changes. If you are doing your own online investing or using self-investing tools, you have to look past the intraday noise and focus on this shift in the business model. To understand where we are going, we have to look at what ServiceNow actually does. At its core, it provides a cloud-based platform that helps companies manage their digital workflows. Think of it as the central nervous system for a corporation. If an employee needs a new laptop, if a server goes down, or if a new hire needs to be onboarded, it all happens on ServiceNow. Their business model is built on high-margin subscriptions with a retention rate that is the envy of the software world, consistently staying above 98%. They've spent the last few years expanding from simple IT service management to HR, finance, and now complex security operations. This diversification is why they've been able to maintain 20% growth even as other software firms have seen their revenue flatline. Looking back at past performance, ServiceNow has been a monster. 5 years ago, this stock was trading at a split-adjusted price near $105 USD. Even with the recent 30% haircut, long-term investors are still up significantly. But the recent volatility is a reminder that the market is currently allergic to potential and is demanding results. This is why many people are moving towards safer options like Fidelity ETFs or Fidelity mutual funds within their Fidelity wealth management accounts to balance out the risk of individual stocks like this one. But for those who prefer active investing through a SoFi trading platform or interactive brokers trading, the current setup in ServiceNow is one of the most interesting in the large-cap tech space. The future outlook for ServiceNow is entirely tied to their rollout of agentic systems. By the middle of 2026, the company expects these autonomous digital agents to be handling end-to-end business processes without human intervention. This isn't just a minor update, it is a fundamental change in how enterprise software works. The market is currently skeptical, expecting these tools to be overhyped, but if the reality is that companies can actually save 50% on operational costs by deploying these agents, ServiceNow will have more pricing power than almost any other software vendor on the planet. This is the catalyst that could send the stock back towards its 52-week high of $239 USD. There are risks, of course. If the macroeconomic environment worsens and we see a full-scale recession, even the most essential software will see some churn. Additionally, competition from giants like Microsoft or smaller, nimbler startups could pressure their margins. Investors using investing sites to compare ServiceNow with competitors like Salesforce often note that ServiceNow has managed to stay more focused, which has been a strength, but that focus also makes them more vulnerable if that specific niche sees a downturn. Whether you are using a Fidelity mobile app or a Robinhood stock trading account, the key is to watch the subscription revenue growth rate. If it stays above 20%, the current price is a steal. If it dips into the low teens, the ceiling narrative might actually be true. The institutional sentiment is currently a hold according to many major banks, with a consensus rating of 3 out of 5. But remember, analysts are often late to the party. They downgraded the stock as it was falling and will likely upgrade it only after it has already started its recovery. This is where the individual investor has an advantage. By staying direct and looking at the raw data, you can see the accumulation happening before it becomes a headline. The current movement is a classic case of a high-quality stock being thrown out with the bathwater during a sector-wide rotation. As we move towards the end of January, the volatility is likely to increase. We might see the stock test its 52-week low of 135.73 USD if the broader market remains weak. This would represent a major psychological level. If it holds, we have a double bottom that could serve as a launchpad for a massive rally. If it breaks, we could be looking at a much longer period of consolidation. This is the reality of investing in high-growth tech. It's never a straight line up, and the periods of maximum pain are often the periods of maximum opportunity. To summarize the situation, we have a company that just saw a 3.00% drop in a single day, ending at 141.80 USD. The expectations are low, with concerns about government spending and a general tech slowdown weighing on the price. However, the reality is a business that is aggressively expanding into security and autonomous agents with a subscription base that remains incredibly loyal. The contrast between the bearish price action and the bullish fundamental developments is creating a coiled spring effect. Whether you are managing your own Fidelity IRAs, using SoFi Active Investing, or just getting started with Robinhood fractional shares, ServiceNow is a name that demands your attention right now. The authority of the ServiceNow platform in the enterprise space is unmatched. They have successfully moved from a niche tool to a global standard. While the short-term traders are focused on the red candles on their Robinhood app, the long-term investors are looking at the cash flow and the strategic acquisitions like Armis. The market is testing the resolve of holders, and as we have seen time and again, the ones who can look past the noise and understand the underlying infrastructure of the digital economy are the ones who come out ahead. In the end, it all comes back to that expectation versus reality loop. The market expects a slow, painful grind lower. The reality of the enterprise demand for efficiency and security suggests a much stronger foundation than the current price reflects. ServiceNow is at a crossroads, and the next few months